The S&P 500 edging higher on the day, but the index did briefly hit that 5,000 mark for the first time ever. The index continuing its upward trend here since the start of the year, boosted by economic data and upbeat earnings. Here to unpack what that 5,000 mark will do to the economy is Dan Griffith, Huntington Private Bank Director of Wealth Strategy. Dan, it is good to see you. So we were knocking right on that door there. We like big round numbers, right? You said something interesting though, Dan, which is you think actually this is going to be, I think you put it like it's going to be the year when investors exhale a bit in the stock market. What do you mean by that?
I think that's the case. I think a lot of, one of the themes for the year is going to be that we're range bound a little bit. There's a lot of optimism, but it's going to be a lot of cautious optimism. And we see in the past when we hit these big round numbers, the market will test it a little bit and kind of go back up again. And I think that will probably be the case here too.
Why do you think that is? I mean, as we've been talking about this theme recently that the backdrop looks strong, right? We've got earnings that have just come in, beat estimates at a faster rate than they have in recent quarters. Economic growth keeps beating estimates. And, stocks keep climbing to records. So what could go wrong exactly?
Well, I think I agree with you that a lot of the fundamentals are pointing in the right direction. And I mean, if you look at what the core fundamentals are that we're watching most closely, there are a lot of what you mentioned, Julie. We're looking at what does unemployment look like? Well, we continue to get good numbers. We did, earlier this week, today, and we did a couple weeks ago. We look at what core inflationary numbers are. Those continue to look very positive. Probably not down to the 2% that the Fed wants, but those look really solid. Consumer confidence remains solid, even in the manufacturing sector, which we deal with a lot with at Huntington. They continue to look solid as well, and there's a lot of optimism, both in the overall numbers, and as we talk to clients individually, they express optimism too. So I think it's really a matter of what, like you said before, what could possibly go wrong. I think it's more along the lines of we want to make sure that we don't think that it's going to go incredibly right? That we want to manage optimism. And that's why range bound is the theme, as I said before.
And as you try, Dan, to sort of gauge where the economy is headed over 2024, you're trying to is it soft landing, recession? How are you gauging that? What's the data? What are the financial metrics you're watching?
I think a lot of them are the ones that we just described earlier. And I think we're thinking that there's a potential of a slowdown. We're at 50-50 as far as a recession, likelihood of recession in 2024. We've been that way for the last probably 2 years, frankly, and it's been a wonderful position to be in. The market kind of was a little less optimistic than we were, and now it's kind of come the other way and met us where we are at Huntington. But at the end of the day, I think we think if the Fed's going to maybe lower rates a couple times as the weather gets a little warmer here, probably 3 times is what our guess is. Then if we are going to have a slowdown, it's going to be a pretty modest one. And we're still optimistic about what the future holds as far as the market is concerned.
What are you hearing from clients? I mean, as you said, you deal with a lot of manufacturing clients. You're in the private bank, so you're talking to wealthy individuals.
Yes.
What's the sentiment like?
Well, I think a lot of them are concerned, right? A lot of people are concerned about, hey, we've had a really good market, particularly last year. Everyone was worried about a recession. But what I hear from clients is that they're a lot more prepared than they were. Whether it's public companies or private companies, a lot of them tightened their belts in 2022 to prepare for what they thought was an impending recession in 2023. Of course, as we all know, that didn't happen. So I think a lot of them begin 2024 with things like interest rates baked in a little bit more. They just begin 2024 a lot more prepared for a little bit of volatility, and frankly, with balance sheets that look pretty good. So it's a very cautious optimism, but optimism nonetheless.
All right, you'll take it. Cautious optimism. How many questions are you getting, Dan? I'm just curious from your clients. How often are they asking you about the election, and what are you telling them?
Oh, Josh, I mean, probably, only probably 100 times a day, right? That's one of the things that's on everybody's mind, and how it's going to affect things.
And what are their questions, Dan? What are they asking?
Well, part of it is just, hey, we have an election. How is that going to affect the market? What's it going to do one way or the other? And you can look at some of the historical data and see in the past how have elections gone, and if the economy was doing well, what does that mean? I think this particular election is, as all elections are, is going to be a little bit unique. I think one of the other things is the market has looked around and said, hey, we're going to focus on our side of the house, right? The Fed's doing the same thing. We're going to do what we can here, and almost eliminated politics from the conversation. So although a lot of people are interested in talking about it, I think it's good to look at the numbers, which ultimately is going to make the real decisions.
Yeah, Dan Griffith, thanks for coming in to visit.
Thank you
Appreciate
for having
it.
me.
Nice to see you in person.
Yes.
Thank you.